What's up guys, your agent Tyler Waverung here, and today we're going to talk more about creative finance, more specifically the HELOC and how HELOC payments work. There's been a lot of questions around this lately in the comments on some of my other HELOC videos, so I want to dive deeper and help explain to you this is a big reason why I'm a big proponent in using the HELOC as the tool that it is to buy property, but this is not a long-term financing play here. You want to have a plan to get in and get back out. For me, that's a 12-month plan. I don't like to go beyond 12 months for a lot of different reasons, but the big one is really how these payments work. So let's dive right in and compare how HELOC payments are different from your traditional fully amortizing loans that you're used to. All right, so you'll see on the left here, let's start talking about something I think we're all familiar with. This is a fully amortizing fixed interest rate mortgage that most people have. All right, let's just say this is over a 30-year period. That's the most common. Fully amortizing is a term that really just means when you get to the end, you don't know anything left. We've amortized it all the way down to zero, and at the end, you get the title, you take over that first position lien, and there's no one else that you have to make payments to aside from the tax person. But there's no other lien holder on the property, right? And so what this is showing, this is kind of the principal balance throughout the duration of the loan. It starts at the very high end and it makes its way all the way down to zero here. And so at the bottom here, this is just an example of what an amortization schedule kind of looks like. You can Google this if you want a more detailed view of this, but this is basically, if you sent your whole $1,000 payment in, this is how it's broken up in terms of principal and interest. Red being interest, black being principal. And throughout the loan cycle, you start out paying a higher proportion of your monthly payment goes to interest, and towards the end, the higher proportion goes to principal. This is because the banks want to get their money back right away, and they let you pay that your bigger half on the back end. So this is an example of what it looks like kind of over the life of the loan. Again, this isn't exact, but just to give you an idea. But the key point here is each time you make one of these payments, you do have a piece of that going to your principal amount. It's paying that principal down so that as you go through here, you are paying that down all the way to zero. So why that's so important to know is the HELOC payment is an interest-only payment. A lot of people go out and buy a property with a HELOC and just think they're on a normal payment. They go ahead and pay their minimum balance every month. But the thing is, most HELOCs have a balloon at the end, which basically means your principal balance doesn't go down at all while you're making those payments. And then there's going to become a point in time, for most cases, it's a 10-year balloon. At that 10-year, you owe the full amount back. And if you don't have that in liquid funds, or you're not able to come up with that or refinance, you're going to be in hot water, and potentially they can foreclose on you or go after your other assets in terms of bankruptcy, foreclosure, things like that. So the big difference is here, you'll notice that this is your principal balance throughout the life of a HELOC. It doesn't go down unless you make deliberate principal payments, but the minimum payment that they give you is interest only. So this is what an amortization schedule looks like when you're making interest only HELOC payments. All of it goes to interest and no principal pay down. So this is the end of the term of your HELOC, and this is when you would be required to pay this whole amount back in full at once. So if you're not prepared for this, if it catches you off guard, you could be in big trouble. So really wanted to just call that out. The big differences there. And anytime you're paying interest only, you're really just throwing money out the door. Now, again, this is an awesome tool to use if you have a plan to get back out of it. Throwing this money away in lieu of a bigger goal or getting a property under contract and getting back out of it, it's kind of water under the bridge. But you don't want to do this long term because it can get you into a bad situation. So my favorite ways to get back out of a property that I bought with a HELOC is either through a BRRRR model where you're doing a rehab to increase the value so that you can refinance and use those funds to pay this back off, or by buying a great deal so far under market value that once you purchase it, you can then just refinance it and pay this money back again. But I've just gotten too many questions around buying a property and tying it up with the HELOC and leaving those payments on it long term. So I wanted to show you guys this. Make sure that everyone understands that it is different from a normal mortgage payment that you make on something like your house, where at the end of a 30-year or whatever cycle you get on it, you are free and clear, versus a HELOC where you really want to pay attention to what that is and also monitoring the interest rates throughout this cycle as those payments could fluctuate. So guys, I hope this was helpful. If you got anything out of it, drop a comment below and let me know what you like. Do you like these drawings? Do you like me up in front of a whiteboard or just chatting with you? So as always guys, a like or subscribe would be greatly appreciated, but we'll catch you next time. I'm Tyler Waverung.